It is 9:33 a.m. on April 3rd. As we're talking, I am logging into my brokerage account and I'm in. It's down 3.3%. Can you tell me what's the S&P 500 as we're a few minutes into the open this morning?
S&P 500 is down 3.06%, 162 points. The NASDAQ is down 4%.
It's a tough day. It's a tough day. I'm going to share a screen. This is the thing that actually happened yesterday. This is the executive order regulating imports with a reciprocal tariff to rectify trade practices that contribute to large and persistent annual United States goods trade deficits. That's a lot of words, and that's why they probably went with Liberation Day is the phrase to describe what happened. So here's what we're going to do, Tyler. We're going to talk about what tariffs are, what was put into place, what was in place before it, and how we as investors are thinking about that.
That's a lot to unpack in a relatively short video, but we'll try to do our best.
We don't want to take a lot of people's time, but give some baseline understanding of what this is, the implications. We know the market's down a ton. By the time you watch this, who knows how much the market's going to be down, but it's a good idea to understand it, maybe have some framework and some mindset to use. I'm Jason Hall. This is Investing Unscripted. Tyler Crow is here with me, of course, from Misfit Alpha. This video is sponsored by The Motley Fool. If you're looking for more great stock ideas, we've got a deal for you. Go to our special link. It's fool.com/unscripted. Check out that link and you can get access to The Motley Fool's 10 best stocks to buy right now. There's a really good chance by the time you see that, a lot of those stocks are probably going to be on sale. Might be worth taking the time to go to fool.com/unscripted and check out that offer. Okay, Tyler, let's start just briefly. What exactly are tariffs and who pays tariffs?
Basically, it's a levy against any good the United States imports from a foreign country. There's been tariff regimens that are either like very pointed towards a particular type of commodity or particular type of good that have been used to adjust unfair trade practices. And that theory, I guess, is being expanded, broad-based, not just on like an individual good or an individual country level, but basically it looks like based on the announcement today for the entire world relative to the United States.
And for reasons, the U.S. trade deficit is more than $1 trillion a year. It is pretty massive. China runs a trade surplus of, I believe, around $900 billion. There's a lot of countries that run trade surpluses. In the Eurozone, Germany is a pretty large exporter. Italy is a net surplus exporter. So the tariff is the charge that's paid by the importer, right? That's who's writing the check to pay the money. So the good comes in from so let's use China as an example. So let's say an iPhone is manufactured in China and it's shipped into the United States. There's a levy that's issued, that's the tariff, that whoever's buying the phone, so maybe it's Best Buy or Verizon, right? As they're buying that phone as it's coming into the US. Sure, they're buying it from Apple, but it's being imported into the United States. So they're paying that levy. Now, here's the key thing, Tyler. Let's say an iPhone costs $1,000 at retail. They're not paying a tariff based on the retail price. They're paying it on their cost.
The cost at the import. So it's like how much it costs to manufacture, how much it basically costs to get it to the port that, brought it into the United States, all inclusive of everything that happened before then.
What's the tariff on China?
Now it's 54%.
So let's say an iPhone sells for $1,000 at retail. It's not a $540 tariff. Let's say Verizon is the importer and it costs Verizon, let's say $400. So they're going to pay a 54% tariff off that $400 cost to import the phone.
Yeah. And we're basing that on this reciprocal tariff that has been implemented, which is 34%. Plus the previous 20% tariff. Now, that could change, but that was what was signaled from the administration's press secretary, that those would be like one on top of the other.
Right. There's the baseline, the discounted tariff, as it's described, and then there's the reciprocal tariff based on the trade imbalance.
I think most people thought reciprocal meant like, oh, if they charge a set tariff for goods going into their country, we would set a similar tariff. That's not how these were calculated.
That's a really good point because it's a different definition of the idea of a reciprocal tariff,
right,
than any other administration has ever used.
Right. Their definition of reciprocal tariff is the total trade deficit in goods that the United States has with another country. You divide that trade deficit by the total amount of goods imported by the United States from that country. It gives you a percentage. They divided that by 2, and that gave you the reciprocal trade tariff rate.
How much the trade balance would have to swing to get it to neutral, essentially.
In theory, yes.
In
theory,
is how that works. So it's complex and it's convoluted, but the point is that's essentially how this is structured. Now, again, the tariff would be paid directly by the importer. Now, what do we know about every tariff, duty, and tax?
Those prices get passed along, baby.
They do. They do. Some of it would be eaten by the exporter as much as they have to, but no more than they have to. So most of it is going to flow through the economic system and get paid by the American consumer of that good.
Yeah. And pretty much any time that we have had tariffs implemented on other goods, that has been the case. Like imported steel price or tariffs back in the 2010s were implemented. The price of domestic steel went up to match imported prices.
We saw that in real time over the past 6 weeks.
Yeah.
Steel manufactured in the United States increased at a commensurate amount with the tariff that was placed on steel being imported into the US.
The theory being is if we have all these tariffs for imported goods, that it's pretty likely that domestically produced goods are going to increase to rates to more or less match what the imported prices are.
Tyler, because it would take us 10 minutes just to name just the names of every country that was targeted, the shorter list are the countries that were exempted here. What do we know about what was exempted?
Canada and Mexico were exempted from this particular round because they fall under the previous tariffs that were implemented a couple of weeks
late
ago.
February.
The other ones that were exempted so far have been Russia, Belarus, and North Korea. And those were exempted because we have sanctions on them and don't have trade with them. So those, and I think there may be one or two others that we don't trade because we have sanctions.
It's a short list. Okay, so what do we know? We know the stock market's reaction is deeply, deeply negative. What are the implications as you see it in the near term and the long term?
I don't know. I know that's really not a great thing because I know people are coming to look to these answers. But one of the things that I feel like we have learned so far with a lot of this, with like the previous rounds of tariffs that were implemented in the early months of the administration, they were announced and then there was like some phone calls between country leaders and then they got pushed out for a month or they were reduced or things like that. So I don't view any of this as set in stone, which makes it kind of challenging, right? Like everyone's a little scared. One of the industries that seems to be getting hit the hardest is apparel and footwear. And because the countries that a lot of that stuff is produced have some of the highest reciprocal tariff rates as a result of this calculation that they're doing. If these things were to last for multiple years, yes, a lot of these companies could be very much affected. However, because so much of this has been in flux, has been so fluid, they were done at the executive level and not codified into law by Congress and then signed by the president and gone through the typical legislative process. They can be reversed just as quickly if they have been implemented. And because of that's why I give the I don't know. And so as a result, to me, I'm kind of looking this as a wait and see sort of situation because this could change at any given moment. And I think it might. Maybe, but if it doesn't, obviously we'll have to change the way we think about this. But for now, one day is one trading day is one trading day. I know that a lot of people are panicked, but I think one thing that you and Jeff Santoro with your colleague for the full Investing Unscripted podcast that you guys talk about don't buy, don't sell, learn. And I think a lot of people could learn a lot about the companies they have, and you'll learn a lot about like their suppliers. Certainly a lot of people are learning where companies like Nike, Lululemon, and On Holdings are getting their fares from these days because countries like Vietnam are very prominently in these tariff things. And as a result, that these are the companies that are getting hit the hardest. It's things like this that you can learn, and it'll make you not a better investor because you will know the businesses that you own better.
There's always, and you wrote about this recently on your Misfit Alpha blog, is that uncertainty is always the normal in the short term. We just don't know what could happen in the near term, and things like this can happen. Obviously, this is to a much, much larger degree than the typical things that kind of come up and surprise the markets in the near term. But I think one of the things that I try to do is understand what is the end game for the administration and what is the goal. The goal is not to tank the economy. The goal is not to tank the stock market. The goal is to create a more favorable environment for the United States. And the end game of that, I believe, is to try to get increased commitments for manufacturing in the US. And I don't think it's to try to manufacture cheap t-shirts for Old Navy. I think it's to get an increased commitments for advanced manufacturing that's highly skilled labor, high paying jobs. I think that's really the biggest goal, is to try to grow more investment in manufacturing of high value goods, either for domestic consumption or to be exported into other markets to offset that trade imbalance. So I think it's typical of what we've seen from President Trump going back to his first administration, is that this is a tool in the toolbox, whether it's exactly constitutional or there's a lot of squinting closely at some fine print to find ways to use these tools, and also having a legislative branch that's allowing it to happen, to use this as an extreme negotiating tactic to really push hard to change the global order of manufacturing. I agree with you. I think things can change really quickly depending on what happens in the larger negotiations. So those are all good things to kind of know and to think about. But when it comes to being an investor and buying stocks and owning stocks and holding stocks, I think we do have a little bit of valuable insight that we can offer. I'd love to hear what you're thinking about your own portfolio, the choices that you're making, and how you're thinking about deploying new capital right now.
Well, I do tend to hold probably a little bit more cash than you do for moments like this, knowing that things can go down just as much as they go up sometimes. And having cash on the sidelines allows you to be opportunistic, allows you to perhaps not freak out as much than when you're fully invested. So I always tend to keep a pretty high cushion of cash. Like I said, as far as what I'm doing right now, I'm reading, I'm sitting on my butt. A couple of percentage points aren't really going to move me in terms of what I want, fundamentally changing a lot of the things that I own in my portfolio. If this does persist for a long time and we see a market reaction to similar for a while, similar to what we've seen today, I think I will be deploying cash. But it really comes down more or less to the business sense and the valuation of those businesses. And, the market always reacts in an irrational way, one way or the other. And being able to buy at rational prices during irrational times is one of the more satisfying things as an investor.
I think broadly, anyone who's looking to sell out of fear in this environment, particularly if it's investments that you don't need to turn into money for many years into the future, I think is a terrible idea broadly, because you're reacting based on what the market is doing. I think if there's any investment that anybody owns that this tariff moment, it upends the thesis, it was probably a weak thesis to begin with. Businesses that have financial strength and real durable economic moats can adapt to whatever the environment may be. Their business may suffer, the stock may go down, but on the other side of these things, these are the businesses that can emerge stronger than their competition and can build on their competitive strengths and end up more profitable and better investments to own than they were when you started. So I always try to think about that. And again, like Tyler said, focusing on, instead of acting in these moments, think about learning and being patient and letting things play out. Is this an opportunity to buy? Sure. I think anybody that had some cash set aside a couple of days ago that they wanted to deploy sometime in the next few days and already had some ideas where they wanted to invest, the opportunity just got better. But I don't think it's necessarily a time to rapidly accelerate those decisions. If it's part of your process to be buying right now, absolutely a wonderful time to do it. But I'm not going into any rush right now. If we do see continued economic weakness from this, if this does look like it's going to play out, the opportunities could get really, really good. To your point, the markets irrationally in fear could give us some really attractive prices to buy for the long term. So that's how I'm thinking about it, continuing to hold a little bit of cash, being patient, going through my normal buying processes, but not necessarily ready to go hog wild and do a lot of extra buying right now. Letting this play out a little bit more, I think, is always a reasonable thing to do. Being invested and then doing nothing is often the smartest decision that we can make. And I don't know that this necessarily changes that.